if that wasn't enough, investors learned today that a junk bond mutual fund is barring investor withdrawals while it liquidates, sending a chill through the credit markets. Dominic Chu reports.
There's a new kid on the street to worry about. Less than a week out from the Fed's expected rate hike, as markets eye continuing global political tensions and a downward spiral in commodity prices, Third Avenue Management announced a block on withdrawals from its sagging focused credit fund, which is down about 13% in the last month and about 27% for the year. The fund has already seen redemptions of nearly $1 billion this year, but now the remaining assets could be frozen for months or even longer. For now, some assets have been frozen, placed in a trust to prevent mass redemptions while the fund figures out how to sell them off. Third Avenue CEO David Barrs wrote in a statement, "Investor requests for redemption, in addition to the general reduction of liquidity in the fixed income markets, have made it impracticable to create sufficient cash to pay anticipated redemptions without resorting to sales at prices that would unfairly disadvantage the remaining shareholders." Hedge funds sometimes freeze assets like this, but this is a mutual fund, and the mutual fund industry thrives because it gives investors the right to cash out at any time. It also comes after regulators have raised concerns that some mutual funds have been investing in assets that could be difficult to sell if markets turn sour. In fact, Carl Icahn is one investor who warned about it months ago and did so again today.
The high yield market is just a keg of dynamite that sooner or later will blow up. There's no liquidity behind these ETFs. The average person that goes into this should basically be warned.
So now the big question is, who's next?
We all knew with this prolonged low interest rates, there were going to be pockets of excessive risk. And, the question was, well, where were they? Well, now we're going to start to see.
And if there are other pockets of trouble out there, just how widespread is the problem? Could junk bonds possibly be the equivalent of mortgage-backed securities like back in 2007 before the financial crisis?
It's a good question. It's a huge market. I mean, again, my gut feeling is that no, because it's much more visible. It's a known commodity here. It's much more publicly traded than all that stuff. But, nobody knows for sure. I think people are jittery.
Those jitters now include fears of a credit crisis, a new plank in the market's wall of worry. For Nightly Business Report, I'm Dominic Chu.